Hello and welcome to the CFO newsletter. Thank you so much for joining me. My name is Sean Allison. Have been away for a few weeks, but I am now back ready to go. So what is going on in the markets? Well, right now the smart money is concerned about a market crash, which we can see here by the skew. Anything more than 135 shows that the smart money is worried about a market crash, a 2 standard deviation or more move to the downside. So right now, the fact that it's 145 is concerning, okay? The smart money is worried about the market crashing right now. If we have a look at hedge funds, we know that institutional investment accounts for 90% of all the trading done on the stock market, 90%. So they have a significant say in where the market goes. What are they doing right now, this institutional money flow? What is it doing? Well, it is selling right now. Hedge funds have become extreme sellers of stock. So, and this is before Janet Yellen said we need to maybe raise rates to stop things overheating. If you have a look at this, right now, we are seeing the most hedge fund selling of stocks that we have seen since the recording of this started back in 2008. So extreme hedge fund selling right now is what we are seeing here. Now, if we look at the overall market, let's have a look at it. So if I look here at the SPX, which is the best gauge of the overall stock market, you can see right now that we are in an opening range bullish mode. Okay, so we've been using the 50 and now the 21 as a support level going forward. But if we have a look here, one of the things that we like to do that's more than 90% accurate is to look at the first trading day of the month and the third Friday of the month. Okay, so if we have a look at this right now on this chart, we can see right now that the first trading day of the month, which I've circled right here, okay, will be the opening range up until when? The third Friday of the month, which is monthly options expiration. So we put the high and the low of the first trading day of the month. If we're in the middle of those two lines, we are neutral. If we're below, we're bearish. If we're above, we're bullish. So just as of Friday, we've now broken into opening range bullish mode. Okay, so bullish mode here. If we look at our workspace to give us an overall market perspective, we can see that, most indexes are doing pretty well. We are seeing a little bit of weakness in the NASDAQ, in technology, and the small cap stocks, the Russell 2000, right? They're sitting right on their 21 EMAs. Okay, so not particularly strong right now, but transport's doing very, very well, along with the Dow Jones Industrial Average. And the S&P 500, it just has now broken into opening range bullish mode. One of the trades that I'm looking to set up now, just to try and give you guys a little bit more info here, and what I'm thinking is gold, right? So I'm setting up a position, not exactly with gold, but with gold miners, okay? Now, part of the reason for that is I'm just seeing now that gold, my computer's freezing up a little bit here, which is most unhelpful. If we have a look here at gold, or the gold miners, should I say, we've now broken out of this downward channel. Okay, so we've finally broken out of this downward channel we've been in since sort of June last year. Okay. Now, since August last year. And we've now broken out of that. Okay, we've had a move up. We've come back and used that as a support level, and now we've bounced higher again. So I do like the look of gold miners right now. Now, I have several hedges on in my account right now, and so do our members. Okay, we've got some bullish positions, no doubt about that. I'll talk about some of them in a moment with you, but we do have some hedges. Now, the reason for that is their record hedge fund selling, which we've already spoken about, but there are always certain signs or signals that precede every market crash. Now, one of the things that I want to look at, we know right now real estate is in a boom, right? In Australia, in the US in particular, it is really going through the roof. Now, one of the things that you want to look for when this market is likely to move down is the ratio between lumber and gold. Okay, the ratio between lumber and gold. If you have a look at lumber, have a look at this move. Just absolutely incredible. The other thing is we're in May, right? The saying in the market is sell in May and go away. Well, that's one thing, but this lumber gold ratio is important, right? Once you start to see lumber, which is represented by IX 1060 here, once you start to see lumber fall in relation to gold, it could be a sign that the market is likely to move down. Okay, now when lumber is outperforming gold, which is exactly what we're seeing right now, risk assets like stocks do very well. Now, the link here with lumber is obviously housing, right? Housing is a leading indicator of the strength of the economy. Most people's wealth is tied up in their homes. Lumber, especially in the United States, is a big part of building someone's house. And what we use this for is to give us an idea when the housing market is likely to have peaked, and also the market is likely to have peaked as well. So when we saw lumber compared to gold at its highest ratio was back in 2005, 2006, just before we saw housing peak. So let me just show you this. Right here, okay? So if we look here, we can see here that the US National Home Price Index. So we can see back here in 2005, 2006, when lumber was its highest compared to gold, then we started to see lumber move down, and that showed us the peak in housing. We then had one of the biggest falls we've seen in housing from that point in time, and the largest drop in history with this particular index. So this is something I'm looking at very closely. We're not seeing it right now, right? Housing still moving up very strongly. Lumber outperforming gold by quite a way. But if I do start to see lumber starting to sell off and gold starting to break out now of that downtrend it's been in since August last year, that's something that's certainly going to get my interest about the market potentially moving down. Some other things that precede a market crash are record margin debt, where people are buying stocks on margin. Okay, so if you need to buy a stock for $100, you've only got to put $50 cash up, and you can borrow the other $50, right? And this is something that's going on right now. Margin debt hit another record in March to top $822 billion. So this is something that is pretty amazing right now. Hit another record. The figure represents a 71% year-over-year jump in margin debt usage. This is extreme. The other thing that we see before any market crash is people becoming a little bit euphoric, okay? The housing market surging, the stock market surging, the crypto market surging. And when all of these markets are surging and people are so bullish, overly bullish, right? There's no one left to buy. This is called insanity. And this is when things start to move down. But I need my opening range to tell me that it's bearish on the SPX, okay? And I need lumber to start moving down as well, okay? But do I have hedges set up now? Absolutely. Obviously, the valuation of stocks as well. When we look at the total market cap of the total stock market compared to GDP, the total economic output of the United States, anything more than 115% is significantly overvalued. Right now, we're sitting at 200%. So stocks are certainly significantly overvalued. And when you look at the PE ratios as well, you can see the same thing. Another thing we see prior to a market falling is record corporate buybacks. And that's exactly what we're seeing right now. A 4-week average of share buybacks hit a record of nearly $2 billion according to research from the Bank of America. So that's another sign. Inflation. Now, obviously, inflation is not good. And inflation is happening right now, right? A lot of people look at CPI, but CPI, there's so many things that doesn't take into account, right? Housing being one of them, right? We're seeing lumber go through the roof. We're seeing housing going through the roof. Food has gone up. When you look at the World Food Index, has gone up for the last 11 months. There is inflation already starting to impact things right now. Rapid inflation is not good for stocks, okay? This will lead to higher interest rates. Printing money will do nothing with inflation. The only way to fight that is to raise rates. That will be very bad for the US government, and it will be bad for stocks as well. Janet Yellen came out and said recently, we may have to raise rates to prevent overheating, okay? There's a huge demand. People have been locked down for a while. They want to go out and spend and get back to normal. Get me vaccinated. Let me out there, right? This is not going to end well for stocks if they have to raise rates to combat inflation. She did try and retract her comments. It didn't really work too well, but that's, these are some of the things that I'm looking at right now. Okay, so I'm definitely have hedges on right now, no doubt about it. Now, one of the positions that we're in, just to give you a bit of an idea about something that we're doing right now, is in Oracle. Okay, so we're in a position with Oracle. We have a long-term call option out to the 21st of January 2022. We purchased this for $885 a contract. It's now increased 25% to $1,110 a contract. So we've made a 25% return on this in about a month. So this has really worked out very, very well for us. Let's have a look at Oracle and have a look at one of the reasons why we're in this. So if you have a look at this, ORCL. So we've had a nice bounce here off this level here at 74, off the 21 EMA. We've had a beautiful move here, okay? And what this has allowed us to do is obviously make a very nice profit on our long-term call option, 25%, okay? Also, what we did at the same time is we set up a spread, right? We set up a spread where we sold the 77.50 call and we bought the 72.50 call for the 21st of May expiry. We did this when the stock price was 76.82 and we did this on the 15th of the 4th. So this has worked out really well for us. We spent $333 a contract to buy the spread, okay, a bull call debit spread. And what now it's worth $4.73. So we've made a 42% return on this, or $140 a contract. Okay, if you had 10 contracts, $1,400 in profit in just under a month. So that is a beautiful, beautiful trade there, and 42% return. So we made money on the spread, and we've made money on the long-term option as well. So what we're going to do now is we are going to lock in profit on the long-term spread. We're going to roll it up, okay? We're going to roll it up now, and we're going to close out our spread. So we're going to make a double lot of profit, okay? And this is one of the advantages that we have as option traders, okay? Part of the dilemma that traders have is look, I've got a great profit right now in this particular trade, but I don't want to get out of it because I think it's going higher, for example. But I don't necessarily want to stay in it because I could lose all my money. Okay, this is a dilemma that traders have. As option traders, we don't have that problem. What we're able to do is do something called rolling, where we close out our initial option, okay? We sell that for the profit, $225 a contract, okay? Or $2,250 for 10 contracts, okay? Depending on what level you're at and how much risk you can take. So we sell that initial option for a nice profit, okay? We buy a new option because the whole reason we're in the trade still makes sense. It's still valid, okay? Now, one of the reasons we're in the trade, let me show you, is because we have a long-term squeeze that is playing out right now, okay? So this is something that is looking very, very good. There's no problems here right now. This still makes sense. So we've got the Bollinger Bands inside the Keltner channels, okay? The 12-period momentum is pointing up and above 100, and we've now broken out, right? So inside the channels here, Bollinger Bands inside the Keltner channels, yellow line inside the purple line if you prefer. We broke out here. We've had about 2.5 months here moving to the upside. So this would typically last 8 to 10 candlesticks. So in this case, on a monthly chart, 8 to 10 months. So this is working out very, very nicely. We made money on the spread and we've made money on the option. But what we must do if you want to be successful with your trading and investing, you must lock profits away when the market makes them available to you. Okay? You, myself, Janet Yellen, the Federal Reserve President, no one knows what's going to happen next. We cannot be delusional here, right? When there's profit there and we can reduce risk, we must do so. This is really, really important. So right now we've made a nice profit. We're going to close out the spread, make a 42% return there, $140 a contract, and I'm going to roll this long-term call option that I've got, okay, for another 258 days. 258 days till expiry. Right? I'm going to roll this as well. Same expiry, same amount of contracts. Okay? So if you have a look at this, the one we initially, this is the spread. No, sorry, let me show you here. Right. Here, the 7250 call, right? We initially bought it for $885. We're selling it for $1,110. Okay? So $225 a contract of profit. We're then going to roll it up. So we're going to roll it from $72.50 up to $77.50, still in the money. Same expiry, same amount of contracts. Okay, so money out when we bought the initial option, money coming back in when we sold it, profit $225. Then we've bought the new option because the monthly squeeze is there. The reasons for getting into the trade are still valid. Okay, that's going to cost us $800 per contract. Okay. $800 per contract minus the $225 we made on the initial option, we've reduced our risk down to $575 a contract. Plus, we made $140 a contract on the spread, the call debit spread. So we've reduced our risk even further. So what's the net result of all this, Sean? Well, we own the 7750 call on Oracle out to the 21st of the 1st, 2022. The current value of that is $8 or $800 a contract. Okay, like I said, we made $225 on the initial option we bought, the 7250 strike call, which reduced our cost basis to $575. We made $140 on the call spread that we set up. That's closed out for a profit of $140 a contract. Our cost basis is now $435. Therefore, we own the 7750 call for the 21st of the 1st, 2022 expiry with a cost basis or risk of only $435 a contract with still 258 days to expiry, and it's currently worth $8. Happy days. What are we going to do now? We are going to set up another spread on Oracle and make even more money and reduce our cost basis even further. If we continue to do this, we could even pay this down so it is zero. So we have none of our own money at risk. This is the beautiful thing about options, the versatility. We're able to lock money in to a trade that's profitable and stay in the trade at the same time. So that is working out very, very nicely. We have done that many, many, many times. Now, one of the stocks that I am looking at is PLTR. Let's have a look at this one. It has been smashed recently. Let's have a look at this. So if we have a look here, PLTR. This is one from a technical point of view that doesn't look that great, okay? This is a pretty decent level that it's just broken below, so it doesn't look particularly good right now. They've come out with some pretty poor earnings. Their CEO has left pretty quickly as well. Doesn't look too good right now for this company. However, if you look past the price here and you look here at what's actually going on, they're actually developing some very interesting multi-year strategic partnerships here. Here's one here, an additional $100 million in new funding. Very interesting. Here's another one here, right? Extending their digital transformation partnership. What is it? Well, it's a data harvesting company and AI, right? That's probably the best way of looking at this particular company. Now, 3M, one of the largest companies in the world, they're developing a relationship to build a dynamic supply chain. Okay, this is starting to look very interesting. Even with IBM and PLTR partner to help Businesses easily deploy powerful and open artificial intelligence applications, unlock valuable data across hybrid cloud environments. Another strategic partnership there, this time with IBM. Rio Tinto. They've signed a partnership with Rio Tinto, another very large company, multi-year enterprise partnership. Even these smaller partnerships here, you add them up, they become quite significant. So right now, yes, it has been moving down pretty significantly. But if you have a look here, what drives a company's share price? Well, it's earnings growth, isn't it? Okay. So what we want is GARP, growth at a reasonable price. And that's what we have here right now. If you have a look at this, current year, not too good. Explains why the stock's been moving down. But again, you've got to be forward looking. What's happening going forward? That's all the market cares about. What's happening next? What's happening next? So down 20% as far as the earnings growth estimates here. But next year, going forward, what's happening? Increase. The next 5 years, almost 50%. So this is looking good. It's certainly heading in the right direction. Earnings per share trend. 90 days ago was 16 cents earnings per share. Now 21. So that's moving in the right direction. Right? Had some positive earnings surprises where the actual earnings were much higher than what the analysts expected. So there's quite a few reasons here for me to take a long-term position in PLTR, and that's exactly what we're going to do. Okay, so that's one that we're setting up. Now, one that we're setting up to the downside is FSLR. Now, as option traders, we can simply just set up put option spreads, a whole range of different things we can do to make money as this stock moves to the downside. It doesn't look particularly good right now. Its revenue's increasing, but have a look at its operating expenses. Very, very expensive here. Operating income actually going down dramatically. So nothing too exciting there. If we look at the analysis here on this particular stock. So this is a bearish position that we're setting up. And obviously with PLTR, we're setting up a bullish position. Long term though, very long term, not right now. But we've got a very good way of building downside protection into the trade as well. So we can see here the earnings per share trend is actually, it was negative 1 cent earnings per share. Now it's negative 23 cents, heading in the wrong direction. Earnings growth rate, not particularly good either. Not looking too good. So this is the company I was speaking about where they lost their CEO, not PLTR. My apologies. So, this one here is looking not good right now. They missed on earnings, okay? They're expecting, the analysts were expecting an 11 cents earnings per share loss, but they actually had 21 cents and their revenue was slightly down as well. So they missed quite badly, and they also forecasted going forward that their earnings wouldn't be very good either. So, this company is not doing too well right now. Okay, let's have a look at this. They're not building strategic partnerships, doing the complete opposite of PLTR. And this stock right now does not look good. So what we're doing is we're setting up a bearish position here. It's broken this significant support level here. Next stop is probably down here at 25.34, somewhere around there, that zone. It doesn't look good. So we've set up a longer term bearish position on this. PLTR, we're looking for it to move to the upside. Here's another one here just to try and give you, this one here is very interesting. This one on ATOS, typically I don't trade stocks that are below $10. But this one's interesting. If you have a look at this, we've just formed a bull flag here above the 50-day moving average. So that projects this moving forward to about 350 as the target. A lot of unusual option activity going on here at strike prices as high as $7, where people are buying huge amounts of call options up here and here and here. So this is one here with a bull flag here. Looks very interesting. The option premiums are very, very healthy. The reason for that is the implied volatility is much higher than the historical. Now, whenever you get that situation, you want to be selling options, not buying them. So we've set up a very interesting position here where we have 23% downside protection built into the trade. If it works in our favor, so it has to drop more than 23% in the next 11 days up until the 21st of May, the monthly options expiry, for us to be losing money, 23%. And if it moves in the direction that we want, above $3, we're going to make a 32.5% return on our money. So this is a very interesting trade that we've set up as well, right? Looking to exploit volatility and with our options trading. And that's another position that we're looking to get into as well. So doing very nicely right now with our trading, but they're the things that we're looking for right now. I hope that helps you going forward. If you've got any feedback, or if you enjoyed this newsletter, please let me know. My name's Sean Allison. Please send your feedback or any comments to support@cashflowoptions.com.au. I hope you enjoyed that. Thank you very much for listening. I'll talk to you again next week. All the best, and bye for now.